As a part of my job, I see a lot of interest from individual investors in real estate as a sector. So a large number of HNI used to participate in these very good quality structured debt products. And I realized that debt is a really meaningful part of an HNI's financial portfolio. But that was not the same case with an individual investor like me back then, where I never had any exposure to debt. And I realized that fundamental reason being that good quality debt products are not accessible to individual investors. And I think that's where the thought came. I also realized that equity markets have done very well for a decade and a half, and now maybe is the right time for debt and for people to understand why debt should be a part of their portfolio as well.
Hello everyone, welcome to our channel. Today's podcast is going to be a special one as we have chosen the topic stock versus bonds. So there have been a lot of discussions and debates on this topic and people like us have a lot of questions in our mind. So in today's podcast, we are going to cover all these questions and we are going to get answers for all the questions that we have been having in our minds. So to answer these questions, we have a very special guest among us, Saurav Ghosh. He is the CEO and co-founder of Jiraaf. Hi Saurav, it's great to have you here.
Thank you, Hemal. Great to do this podcast together. Looking forward to this.
Saurav, before we go ahead, I just want you to introduce yourself and tell about your past experiences and also how did you land up into this finance industry?
Right, yeah. So just to give some background, I'm basically born out of Mumbai. I did my engineering from Goa. Then I did my MBA from Ahmedabad. Post Ahmedabad, I basically got into this company called Feedback Infra, where I used to work in the consulting and then the corporate finance departments. So I got into basically fundraising for this company. I used to raise both equity and debt. Post Feedback, I joined a developer in Mumbai, where I transitioned to real estate, and then a developer in Bangalore. For all of these organizations, I used to essentially raise a lot of debt capital. And as a part of my job, I used to see a lot of interest from individual investors in real estate as a sector. So a large number of HNI used to participate in these very good quality structured debt products. And I realized that debt is a really meaningful part of an HNI's financial portfolio. But that was not the same case with an individual investor like me back then, where I never had any exposure to debt. And I realized that the fundamental reason being that good quality debt products are not accessible to individual investors. So, and I think that's where the thought came. I also realized that equity markets have done very well for a decade and a half, and now maybe is the right time for debt and for people to understand why debt should be a part of their portfolio as well.
Right. So sort of from engineering to MBA, what made you decide to go into the finance industry and start your own business?
Yeah, so I was a computer science engineer, at BITS. So I didn't really obviously recognize myself a lot with coding and development side of things. I was more interested in business, finance, management. I used to be a part of the entrepreneurship club back then in my engineering days. So my keen interest has always been on the business side of things. So I thought the natural progression was to do my MBA. And I've always been interested in finance and numbers. And I think being a fresher, it was a natural choice for me back then.
So Saurav, thanks for sharing this information. The first thing I would want to ask you is, how would you describe the risk return profile of stocks as compared to bonds?
So typically we associate stocks with a lot of, I would say, long-term growth. But with that long-term growth comes a lot of volatility. So, typically stocks are affected by macroeconomic environments, like let's say COVID happened, US election happened, US increased interest rates, inflation in India, see growth potential and how India is doing as a country. There are a lot of macroeconomic shocks which lead to short-term volatility over a 1, 2, 3 year horizon. So while stocks, we understand are great from a long-term perspective, at least that's how it has historically performed. But for a short term, when you have a 1, 2, 3 year horizon of your portfolio, it may not be the most stable asset class. Right. You go through a lot of ups and downs, which cause a lot of anxiety, I would say, to an investor when they see their financial portfolio suddenly, maybe down by 20-30% in a short period of time. So while stocks, we understand are great from a long-term perspective, at least that's how it has historically performed. But for a short term, when you have a 1, 2, 3 year horizon of your portfolio, it may not be the most stable asset class.
Right.
You'll go through a lot of ups and downs, which cause a lot of anxiety, I would say, to an investor when they see their financial portfolio suddenly, maybe down by 20-30% in a short period of time. But now, if you look at bonds on the other side, bonds are by nature are predictable and stable. So what we mean by bonds is when you invest in a bond, you exactly know when you will get your money back, how much you will get back. So you know that I'm going to get an X percentage return over a Y period of time. So that kind of predictability is what gives an individual investor comfort in investing in that asset class. So there is no volatility attached to it. You know that I will make 12% return or 10% return, and that's kind of certain, fixed. So I think so that's the key difference. Obviously, associated with bonds is a different kind of risk, which is what we call as credit risk. But when you invest in very high quality bonds, when you invest in papers which are AAA, AA, A minus, even triple B plus to an extent, because the credit quality is good, the likeliness of defaults are minimal. So I would say that bonds are more stable. They obviously, because there is a lesser risk associated with it, the returns are lower. Equity, on the other hand, might give you better returns over a long-term portfolio, long-term horizon, but for a short term, they are highly volatile. The other caveat I want to add is that it's not necessary that in equity markets you will see even positive returns over a long period of time. So, both Japan, US have gone through periods of 10 years or 20 years where they have not seen even, maybe 5% return on an absolute basis. Right, so that kind of unpredictability in equity markets is something that is not maybe suitable for every individual investor, and that's where bonds come in, where it gives you stable and predictable returns.
So usually people in their 20s invest in stock market, whereas people in their 30s start gaining knowledge of bond market. They explore bonds and debt market and everything, and then they start investing in their 30s. So do you think people in their 20s should start participating in bond market?
Yeah, I think that's a great question. So, at least from my perspective, I think the natural investment journey for an individual should definitely begin from fixed deposits, which is, I would say, the safest asset class in India.
Okay.
Post that, you can, I would say, migrate to bonds or transition to bonds. Thereafter, mutual funds, and maybe once you have, a good sense of what financial portfolio means, what the risks are with every investment asset class, you can then probably start dabbling in equity markets yourself, directly as well. I think it's quite different in India because of the lack of awareness of all the products. People in the early 20s get excited by the potential of stock markets and start investing in it very early. I would say that when financial corpus is limited, you should invest in something that is predictable and stable, because you don't want to invest in high volatile instruments when you have a limited financial corpus, and hence you should begin with fixed deposits definitely, and then the natural transition should be bonds, where it gives you that delta or higher return compared to fixed deposits. So you're taking higher risk, but your return profile is still stable and predictable. And probably once you have a corpus which you can set aside for a long period of time, maybe for 5-10 years, you know that you don't need this pool of capital and it can be just kept aside. That's the time when you can start investing in equity markets. I would suggest that all people in their 20s should actually use bonds as their first step after fixed deposits in their investment journey.
So do you think people in their 20s can diversify their portfolio between both of these asset classes?
Yes, definitely. So I think having fixed deposits, portion of your portfolio in bonds, and then in mutual funds to begin with, is a great way to diversify, because also when you're early and in your early income journey, in your 20s, that mutual fund exposure also can give you long-term returns, and the bonds can give you that stability and predictability in a short period of time, or in the near to medium term of your next few years. Right? So I think it's a good balance to have all of these three in your portfolio, and definitely people in their 20s should start even exploring all the three asset classes, so that when they are maybe in their 30s, have a larger financial corpus, they are more informed and educated about how to create their own portfolio.
So Saurav, how can people plan their financial goals starting their investment journey today?
I think everyone should split their goals into three buckets. One is long-term, medium-term, and short-term goals. Typically, long-term goals will be, for example, retirement. Medium-term goals can be buying a car or a house,
Right.
and then short-term goals can be as simple as going on a vacation. right? So you can categorize based on the investment horizon that you're looking at. And as I said, typically equities are a good asset class for your long-term goals. But let's say you want to go on a vacation next year, or you want to, say buy a car in 3 years' time, then setting aside some money or corpus and then investing in equities for that goal is not the right way to do it, because you don't know after 3 years whether equity markets will be up or down, and whether your investment will actually meet that financial goal or not. So typically for these kind of investments, I would generally recommend fixed deposits or bonds, and bond will give you that additional return, which can be quite helpful in these cases. So, for example, if you want to go on a vacation 1 year down the line, you can invest in a bond with a 1 year horizon, which that you get your money back with the return within a 12-month time frame. Right, so you can invest 100 rupees today and expect that you'll get 112 a year down the line. So you kind of made an investment, and that helped you, subsidize in some sense your cost of vacation a year down the line. Similarly, if you want to buy a car in 3 years, you can invest in a bond which is of 3 years maturity. So typically, hence fixed income and bonds, because of their predictable nature, are great to invest with identified financial goals for short to medium term. And obviously, I would still recommend that equities and mutual funds are a great way of investing for long-term goals like retirement, etc.
Thank you so much, Saurav. This was very insightful. So, Saurav, do you think the change in interest rate policies can affect bond market?
Yeah, so typically with change in interest rates, your bond prices change. But if you're an individual investor, actually there is, I would say, with a view to hold that bond to maturity, then the interest rates don't actually impact you. So what I mean by that is, let's say interest rates goes up by 25 basis points. Because of interest rate increase, bond prices will actually fall. If there is a institution or players who want to buy and sell bonds, then that is something they need to take a view on. Whether the interest rates are likely to increase or decrease. Let's say interest rates goes up by 25 basis points. Because of interest rate increase, bond prices will actually fall. If there is a institution or players who want to buy and sell bonds, then that is something they need to take a view on. Whether the interest rates are likely to increase or decrease. But I, as an individual investor, if I have invested in a bond which at the time told me that I'll get 12% return over a period of time, whether the interest rate cycle, interest rates move up or down, if I hold the bond to maturity, I will make 12% on my investment. Right. So since I'm holding the bond till maturity, any change in interest rate actually is not impacting me. But yes, if I need liquidity and I need to sell that bond in the market, then obviously interest rates going up will reduce my price, and there might be what we call a mark-to-market loss or an actual loss if you go about trading it. If interest rates fall, then the bond prices will increase, and I can actually make some gains if I sell that bond in the market. But most individual investors should use it as a hold to maturity product. That means you stay invested for whatever is the tenure of your bond. And in this case, interest rate cycles don't impact you at all.
So basically, for individual investors, their interest rate will not get impacted if they stay till maturity. So Saurav, while I understand that bonds have stable and predictable returns, we have seen this DHFL case in the past. So what would you tell? How should investors tackle this situation if there is some situation that arises in future?
Yeah, no, that's a great question. I think typically we are associating bonds with stability and predictability, but once in a while DHFL situation occurs. So I think first thing you should understand is that every investment in India carries risk, right? So if even a fixed deposit carries a certain kind of risk, bonds carry risk higher than that, so on and so forth, right? So every investment carries risk. The only way to diversify, the only way to manage risk is through diversification, right? So if you are investing X amount of rupees in bonds or allocating X amount of rupees to a bond portfolio, you should do that across maybe 5 or 10 different counterparties. So in case, in a very, I would say, a small percentage chance that a DHFL occurs and you are caught in it, the impact on your financial portfolio is minimal. we should always remember that DHFL situation and these kind of situations are rarities. They are outlier events, but these do happen once in a while. You don't want all your eggs in one basket where you get caught and it has a big erosion of your portfolio. And hence, I think diversification is the first step in creating a good financial portfolio, right? And you should invest across 5 to 10 bonds. The second bit is now, like Jiraaf, there are so many, okay, I would say, bond platforms, and I think we are trying to bridge that gap where individual investors are not aware of the counterparty. They are not aware of whether DHFL is a good counterparty or a bad counterparty. So a platform like Jiraaf is today actually curating and selecting and bringing good quality bonds onto the platform that helps you filter the kind of product that you need to look at. You can obviously understand the counterparties and read the information and make your own decision, but at least another level of filtration has been done by a platform like Jiraaf. What this assures is that earlier DHFL, for example, was a AAA rated bond which still defaulted. Right. So as Jiraaf, you're not only going by a credit rating agency, but we are also doing our own internal credit assessment and doing our own filtration and curating a specific set of bonds which we feel is good for retail participation, and that makes your job or an individual investor's job easier. So I think that's diversify and invest through bond platforms. I think these would be my two recommendations.
So I've seen a lot of people participating in the stock market. There's a lot of day trading, futures and options that people participate in. Why do you think there is no much participation in the bond market?
Yeah, so I think that's, today, because of, I would say, a lot of awareness, by mutual funds, by a lot of technology platforms like Zerodha and Grow. I would say awareness about equity markets is at an all-time high, and it is increasing with time. I think the similar, I would say, an ecosystem for bond markets in India is not present right now, right? So as Jiraaf, as other bond platforms, we are trying to educate people, about what bonds are, how should they invest, how should they make it a part of their financial portfolio. But this is always a journey. If you look back at India in the 1990s, when equity markets opened up, only HNI used to participate. Mutual fund industry opened up in 2000, but again in 2000, largely it was an HNI market. It's taken a decade and a half for mutual funds and equities to become mainstream, right? So I think that's the journey for bonds has started now. You will see that over the next decade, bonds will become mainstream. And I think technology like platforms like Jiraaf will have a big role in deepening, bond markets and also educating the users about it. I think for investors, they should, always keep evaluating new asset classes because as, I would say financial markets improve, you will have, asset classes even beyond bonds. You should always be aware of what they are and make a choice whether that makes sense to you or not. So I think yes, bond markets are not very highly spoken of right now or not spoken about enough, but I think that's going to change in the next few years. And I think the government also has a big role to play. There's been a lot of chatter about reducing ticket sizes to make retail friendly, investments retail friendly. Also, I think taxation benefits in bonds will be a big impetus to the bond market. So I think things will change over the next decade. I think bonds will be very close to where equities, will be valued.
So Saurav, this is my final question, and I wanted to know about this. So, what do you think? How's the bond market currently, and how is it evolving as compared to last decade?
I think bond market is today very institutional. What I mean is, I think the 5-6 PSUs or government agencies are the largest issuers, between NHAI and maybe some private companies like, HDFC Bank, SBI, NABARD. I think they are probably 80% of the bond issuances, from a issuer perspective. On the subscriber perspective, mostly again pension funds, large banks, they are participating in the bond market. So it's a very institutional market, both on the issuer side as well as the investment side. I think that is changing now with the advent of bond platforms. I think there is more awareness in retail investors as well. They understand the category much better than what they did last decade. So now we are seeing two changes. One is on the issuer side, a lot of companies are also tapping bond markets to raise capital. I think which I would say smaller companies did not do so a decade back. So even a company which is A rated, triple B plus rated, triple B minus rated, they are tapping bond markets to raise capital as well. So that's been a shift. There's a lot of interest from wealth firms, distributors, and HNIs, in participating and even investing in these products. Secondly, also on the demand side, I think that, as I said, there's a lot of retail participation. I think last year and a half, there has been almost 400% growth in retail investors participating in bond markets. I think that, as I mentioned, this kind of growth will continue for the next decade. And hopefully, we'll see a very vibrant retail market and a bond market a decade down the line.
So thank you so much, Saurav. It was amazing having you here, and all the information that you provided was great. It was great having you here, Saurav. Looking forward to meet you again.